If you're a business owner in Canada responsible for paying dividends or investment income, one thing you absolutely need to know is how to prepare a T5 tax slip. While you can certainly have your accountant do this, it's actually quite simple to do on your own, as long as your books are up to date. Today, I'm going to walk you through how to fill one out correctly. What is a T5 tax slip? Let's start by talking about what a T5 tax slip is. A T5, or return of investment income, is a form you use to report payments like dividends or interest income paid to individuals by your company. Dividends are one of the most common types of payments reported on a T5. These are distributions of profit paid to shareholders, and if you're a business owner, you're responsible for issuing T5s to anyone who received more than $50 in investment income from your company. This includes yourself, if you are choosing to receive dividends as your income instead of being on the payroll. Types of income reported on a T5. A T5 slip can include dividends, both eligible and non-eligible, interest from banks, interest from loans, bonds, or investment accounts, royalties from natural resources, certain insurance payments. Now, here's something super important, the deadline. You must file the T5 by February 28th each year. This is the same date for all business owners because the T5 is reported based on the previous calendar year, not your company's year end. Missing that deadline can result in penalties that can easily be avoided. All right, now let's go over how to fill out the T5. First, make sure you've identified which payments are dividends and which are not. For example, things like shareholder loan repayments or payroll payments cannot be reported as dividends. Your bookkeeper should have these correctly separated in your books under the titles such as shareholder loans, payroll expense, and due to shareholder. The amount in the due to shareholder account is what will be included in the T5. Eligible versus non-eligible dividends. When reporting dividends, you'll need to know if they're eligible or non-eligible. The main difference between eligible and non-eligible dividends is that they are taxed differently. Eligible dividends are taxed at a lower rate and only apply to profits exceeding $500,000. Non-eligible dividends are for dividends paid to an individual from company profits that are less than $500,000. The GRIP, General Rate Income Pool Calculation. The General Rate Income Pool Calculation is how you determine the type of dividend being paid, eligible or non-eligible. It is not an actual bank account, but it is a cumulative account that eligible dividends are paid from. The GRIP account can be a positive or negative amount and is only computed at the end of a particular taxation year. This means calculating the GRIP balance is important because it can help minimize your taxes. For example, assume your company pays out $600,000 in dividends to its shareholders and its GRIP balance is $100,000. In this case, $100,000 of eligible dividends will be paid from the GRIP account and taxed at a lower rate. Your company will need to fill out and file the T2 Schedule 53 form. We'll cover that form in a later video. Let's walk through an example. Suppose you're a painter who made $700,000 in profits. The entire profit is paid to you in the year. Here's how you'd calculate the correct numbers to fill in the T5 slip. Actual eligible dividends. Dividends paid from profits over $500,000. $700,000 minus $500,000 comes to $200,000. Taxable eligible dividends. The taxation of dividends is affected by the dividend gross up, which is 38% for eligible dividends. $200,000 multiplied by 1.38 equals $276,000 of taxable eligible dividends. Dividend tax credit for eligible dividends. This is calculated by multiplying the taxable eligible dividend by 15%. The dividend tax credit reduces your personal income tax. $276,000 multiplied by 15% is equal to $41,454. Actual amount of dividends other than eligible dividends. These are dividends paid from profits less than $500,000. $500,000. Taxable amount of dividends other than eligible dividends. This number is calculated by multiplying the actual amount of dividends up to $500,000 by 1.15. $500,000 multiplied by 1.15 comes to $575,000. Dividend tax credit for dividends other than eligible dividends. This number is found by multiplying the taxable amount of dividends by 9%. This credit can be claimed on your personal tax return to reduce your taxes payable. $575,000 multiplied by 9% comes to $51,923. In the end, this is what the painter's tax slip would look like. Once you've completed the T5 slip for one individual, you'll need to do so for all other individuals in receiving dividends. Once you have all the T5 slips, you will need to fill out a T5 summary for all of your shareholders. Add up all of the T5 slips into the summary. Then you can submit all of the T5 slips and the T5 summary to the CRA through My Business Account portal. Again, make sure you do so before February 28th. By following these steps, you can prepare a T5 tax slip easily and accurately. If you need more guidance or have any questions, feel free to reach out by going to our website, madanca.com, which I've included in the video description. Thanks for watching, and don't forget to like and subscribe for more accounting tips.